Hi, good morning, everyone, and welcome to the next in our series of Tobias Wealth Wisdom monthly chat. Today, I'm here with Yesenia Ramirez, who CFP and one of our financial planners. She's going to be talking to us a little bit about life insurance and hopefully answering questions that you have about the different types of life insurance. How much do you need? When do you need it? Do you need it? And answer any other questions that you have about life insurance. So welcome, Yesenia.
Thank you, Edgar, for having me. I'm really excited to speak with you all this morning about life insurance.
Excellent. Before we get started, our typical just disclosure, really the main point here, the information that we're presenting is informational only. It doesn't involve any rendering of personalized investment advice. If you have any specific questions to your situation, then speak with your professional, either advisor or insurance agent, and I'm sure they'll be able to help you. So this is a conversation, and it's going to be formatted, with question and answers. And I have some questions here for Yesenia that I think will give her a good opportunity to talk generally about insurance. But at the same time, we encourage attendees to ask questions as well. There is a question or a chat box that you have in the meeting software. So if you have any questions, please type them, and you can type them throughout. We'll get to them either during the presentation or after the presentation. If for whatever reason we can't get to them during the presentation, since it's just 30 minutes, we'll make sure that we get back to you. So why don't we get started with kind of like a general overview, Yesenia? I mean, what is life insurance, and why do we see people get life insurance most of the time?
Absolutely. So life insurance in its purest form is a risk transfer strategy. It means that you are purchasing a contract where a company promises to pay a death benefit if you pass away. And it could be within a stated period of time. You could have it in place for your whole life. We'll get into the different types that you can purchase, but generally speaking, it's a policy that when you pass away promises to pay out to your intended beneficiary. And the reason we see this is, there's a variety of reasons why many people can buy life insurance. One of the main reasons people buy it is really to protect their loved ones. If you have any financial dependents, that could be a spouse, children. And if you pass away early, we don't want to leave them without enough assets to maintain their lifestyle. So really, life insurance is transferring that risk to an insurance company to ensure that your loved ones have enough assets, either to pay your debts if you still have a mortgage, to pay for their college, to pay for living expenses until kids are, out of the house and on their own, starting their own career. Some people have concerns with regards to funeral expenses if they haven't been able to build up enough assets to pay for that. And one of the ways that we see sometimes are to pass wealth to heirs, even if they have sufficient assets. Some people see this as a way of creating an inheritance for some heirs. And in other situations, once we have larger estates, it can actually be used to mitigate estate tax.
That's really helpful. So we get a lot of questions around life insurance, whether it's existing clients or prospective clients that come to us with life insurance, and they're often kind of confused as to whether they should or should not get life insurance. So can you tell us a little bit about what are some of the situations or criteria, like when should someone get life insurance? Does everyone need life insurance? Should I get life insurance for my kids? How do I think about the situations when someone should actually go out and buy life insurance?
So the simplest answer to that question is when there is a need for it. A lot of people hear that, when they're in their 20s, you should consider getting life insurance because it's cheapest. And while that may be true, you want to think about the need first. Do you have anybody in your life that if something happens to you today is depending on you financially? And if the answer to that is no, then you really don't have the need for life insurance, and it's just not something worth paying. I have some kids of clients who are in their 20s paying for life insurance policies, and I ask them, if something happens to you, who are you protecting? And life insurance proceeds are going to parents who have they're not depending on kids for assets. So the kids are really paying for something that they don't need at this point in time. So that really is the first step, is determining need. And that, it's usually that survival question. Is there someone in your life that if you passed away today are depending on you financially? And that could be a spouse or kids, is usually the two main reasons why you would need life insurance. Now, there's a few other special situations, but generally, certain life events are going to prompt the need for life insurance, and it generally starts when you're a little bit younger. So, for example, marriage or the birth of a child, you could be in your 20s, 30s, 40s, maybe haven't built up enough assets, and that's when your need for life insurance is at its highest, when you don't have enough assets. If you're older and have enough assets, maybe you're in your 60s looking at retirement, you have enough assets if something happens to you today. Do you really need life insurance? Do you need to keep paying for it? So that's one of the things that you should consider, is that need, and those are some of the things that prompt it. Another one is potentially a home purchase. Even if you're not married and you purchase a house with somebody, they may be financially dependent on you. Is there a need for life insurance if something happens to you? Can they continue living in that home if you were to pass away? Divorce can be another example, especially on the alimony paying spouse, if there is one. If there wasn't life insurance before, there may be one mandated by a separation agreement, that if something happens to the alimony paying spouse, that there be life insurance, so that the spouse that is relying on that alimony gets that financial assistance. And there could be other situations too, that are a little bit outside of that realm. One could be a special needs child. That could be an instance where if something happens to you today, you're worried about the needs of your special needs child. They generally have higher expenses just in additional support that they may need. It depends on the abilities that they have as well. Are they able to support themselves? So for special needs children, you may be considering a longer term, perhaps permanent policy, because the need may always be there. Business owners may need life insurance policies in terms of a buy-sell arrangement, in case you have a partner in the business, and if one passes away prematurely, the other one may need the liquidity to buy out the other partner's share. And then high net worth individuals with taxable estates, having a permanent policy in place to cover potential estate tax is a strategy that I'm sure we'll get into. I'm sure you have that question, but that's another time that you may need to consider life insurance.
So, like, if I'm a business owner and I have an agreement with a partner that says if something happens to me, you need to buy my shares in my business. One of the things that I can do is get a life insurance policy, or they can get a life insurance policy on me, so that if something happens to me, they don't then have to kind of find this money to buy those shares, right? Because obviously my heirs now will own half the company. Now they may not necessarily want to own half the company, right? Or a portion of the company. They might prefer that the other partner buy it out, but it's going to be difficult for them to do it if they don't have the assets. So is that the way like that would work?
That's exactly how it would work, because that other partner may not want to be in business with your spouse and children. Your spouse and children may not want to be in that business if you're no longer there. And generally speaking, unless that business owner at that point has enough assets to buy your share, may or may not have the liquidity to buy it out. So this offers that flexibility, really. If that business owner wants to continue and buy out your shares, they can do that.
So how much insurance I need, let's say under that situation, is I guess it's pretty straightforward, right? Because you want to base it on the value of the company or value of your shares or some number close to that. But what about?
And we usually look at appraisals for that.
Right.
That one's easy.
Now, what if like I'm just married in my 30s or 40s? Maybe I have one or two children. I have a house with a mortgage on it. How do I know how much insurance I really should get? Should I just cover my mortgage? And, maybe I have assets. I have a 401k or maybe a brokerage account. Like, how do I really determine how much insurance I should get or how much insurance I need?
So that's probably the hardest question to answer because it's usually easy to determine whether you need it or not. But the next question is, well, how much do I need? And there's a few different rules of thumb. One of them is anywhere between 6 and 10 times your salary. That's, I'm just going to say again, a rule of thumb may or may not apply to you. It may depend on your lifestyle, how much you may actually need. But that's a good place to start to give you an idea about how much life insurance you may need to purchase. Another thing that we can do is take a look at your earnings. So how much are you earning today? And if something happens to you now, how many years of earnings potential is lost? So let's say you're 30 right now, you have about 35 years of working times your salary. That's another rule of thumb. It may come up to quite a large number. So again, rule of thumb. Or you may just look at how much your home is. If you say, you know, if something happens to me and my spouse will be okay, I really just want to pay off the house, then you may consider just having life insurance that's enough to cover the house. And you may, you know, that's a really good example of why you would need a term policy, because year after year that balance is going down on the mortgage. And at some point it will be paid off. So it really depends on what you're trying to provide for. Another example that we get a lot is for a non-working spouse that perhaps is staying at home and watching the kids. You know, there's a misconception out there that only the working spouse needs life insurance, but there is a value that the non-working spouse is adding when they're caring for children. So you may want to consider, if something happens to that spouse, what is the cost of childcare from now until they're 18? And that may be an appropriate value to have on the non-working spouse's life. So it really depends on the need that you're trying to fulfill. Are you trying to make sure that all living expenses are covered for spouse and children? Or are we trying to make sure the debt is paid off? So that's going to be a really good way to gauge how much you might need. But I really do think that tying it into a retirement projection and doing an actual life insurance needs analysis is the best way. And the reason for that is that it ties in what your actual living expenses are and what your current assets are. You know, so we're not just blindly saying, okay, we need to have X dollars because this is what we're going to make over the next 10 years. It also takes into account what you currently have. And that's how we approach life insurance. We always tie it into that retirement projection, get to know how much you actually have in assets, and also get to know what your current living expenses are and what we expect it to be in the future. So we really tie that in, and that's really the best way to gauge that amount.
Yeah, that makes a lot of sense. You know, the other thing that I've heard too is, you know, some people say that maybe life insurance is a good tool, like for college savings. I mean, is that, you know, what do you think about that, or how would you do that review or analysis?
So I've seen that often where they'll do life insurance on a child's life. And while that's certainly an option, I believe that today there are so many different tools for college that are a lot more inexpensive than a life insurance policy. At the end of the day, a life insurance policy is meant to pay out on the death of the insured. So this would be on the child's life. And then, of course, you can take the cash value out later. But life insurance policies tend to not grow as much because, again, they're usually structured in a way that has downside protection, which means there's sometimes a limit on how much growth can actually be applied. Plus, there's a cost to the actual insurance portion. And if we don't need the insurance portion on a child's life, then why is that something paying for? So I think between the use of 529 accounts, which have that same tax deferred benefit that a life insurance policy does, I think that's generally speaking a much better option for college savings and a much lower cost option for college savings, or even in Florida prepaid account if you know your kid is going to school in Florida. So I think that given all of the different vehicles we have today, perhaps in the past it may have been a good tool that was beneficial, but with all the tools we have today, I think there's better ways to save for college.
So you mentioned, you know, kind of how life insurance fits into your retirement planning or just your financial planning in general. So I'm going to, you know, kind of think of it, I think of it this way, right? So, you know, if I have no heirs, I have no children, you know, maybe I have a home with a mortgage and I have, you know, family that will get my assets if something happens to me. But I also have, let's say, $1 million in a 401k or an IRA or whatever the number is. And if I feel that, hey, if something happens to me, that $1 million could be used for these things, right? To pay for my funeral, to pay for my mortgage, and then, whatever's left over, then my family can, my heirs, whoever I decide to leave it to, or charity, what have you. I probably don't need life insurance in that situation, right? I mean, what if I only have $1 million, but I want to leave my kids $5 million, right? Does it make sense for me to go and get a life insurance to cover that, for whatever the reason might be?
So that's a really good question, and it really depends on what we're trying to achieve, and also the opportunity cost of that policy. So one of the things we look at is this life insurance policy a good deal, let's say. So in that event where we know we really don't need it for survival purposes, we're looking at it sounds more like an investment. We're trying to maximize the amount that our heirs are going to get, even though they don't truly need it, but we just want to maximize how much they get. Then we're trying to compare this to an investment. And that's how life insurance policies generally get sold, especially the permanent ones with cash value, is that they're a good investment. So we do a side-by-side analysis on this, and I say, okay, if you want to take those premiums and pay a policy that's going to pay out $1 million when you pass away, those generally tend to be a lot more expensive, about 10 to 20 times more expensive. Can we take those same premiums and invest them in an investment diversified portfolio and, let's say, break even with that death benefit? And oftentimes the answer is yes. And it depends on the policy too. We've seen a few where that's not the case. No matter how we invest, we're never going to reach the death benefit. But then there's others that if we take the premiums and invest it, we will have made up the death benefit by the time the client is 76 years old. Mm-hmm. So the way we look at that is we say, okay, if you pass away before 76, life insurance is a better deal. However, if you pass away after 76, then perhaps investing that in a diversified portfolio would have been the better deal. So I think that age is kind of that crucial component. Of course, you never know when someone's going to pass away.
Right.
But if it's young enough, if that crossover happens soon, then you're probably better off in an investment portfolio with the life insurance than a portfolio. But if that crossover is later on, then it just might make sense to go with that portfolio.
Right. Yes. I mean, I guess ultimately it depends on the investor or the person too, right? So obviously the insurance in many ways is guaranteed, depending on the type of insurance, but you don't know when you're going to need it, right? So that's the benefit of the insurance, depending on how much risk they're willing to take. Whereas investing in it obviously, has a time horizon and the same idea. You just never know. So I guess it comes back to ultimately, what is your goal? What are you really trying to accomplish with that life insurance, right? If it is what I mentioned before, having more assets for my heirs, then maybe investing in makes more sense. But if it's more around covering a mortgage or my kids' college costs, which, if I die young, then insurance might be better suited for that, right?
Absolutely. And because the thing is, if you're trying to cover a mortgage, cover survivors' living expenses, then it doesn't matter how long you invest for. You probably can't make up the death benefit because you may pass away soon and you just don't have enough assets. So that's where we look at life insurance as a pure insurance rather than an investment. There's a risk that we're trying to cover for. As far as leaving assets to heirs, that's where we start looking at it as more of an investment and compare it to actual investment.
That makes sense. So one of your points here is in using it if you have a taxable estate. And I know tax laws changes all the time, but I think you have an example of how we would look at that, and because that might be a good situation where you want to get insurance, I guess, to cover the taxes, right? Maybe you can kind of walk us through what that analysis looks like.
Absolutely. So when someone has a taxable estate, that means that they have more than the estate tax exemption, meaning that there is a value of their estate that they're going to have to pay estate taxes on. So our analysis consists of looking at what's our total taxable estate. So that's what we have here on this chart in the blue. And then we compare it to the estate tax exemption. So right now, this is an example for a married couple between two spouses. we have about a $23.1 million exemption. So if we looked at this couple who has about $9 million, almost $10 million in assets, there is no taxable estate. Everything that they own can pass to their heirs estate tax free. So, and in this instance, we wouldn't need life insurance because there are no taxes to pay for upon this person's passing. Now, we do know that in 2026, the exemption is set to sunset to what it was before the Tax Cuts and Jobs Act, and it'll drop to about $13 million between two spouses. So even in this situation, this person doesn't have a taxable estate. However, now we're living in very interesting times, and we may have a potential election impact. So there's a lot of uncertainty around this. So we'll see how things shake out in the next 2 years. But based on conversations with the Biden election, or a Biden win for the election, was that the estate tax exemption is most likely to drop. And some of the figures that were thrown out there were 3.5 per spouse or 7 million total. So in this example, someone with a $9.7 million estate would actually have $2.7 million as a taxable estate. So that means that 2.7 would be subject to a 40% estate tax, which would come out to about 1.1 million. So depending on the mix of your assets, you may have the liquidity to pay it off. We've seen clients where everything they own is in real estate, and then they have to start selling real estate to cover the tax due. So especially in that situation, it's really nice to have life insurance to cover that tax and also to maximize how much your heirs are going to receive. So in this scenario, if we have a $2 million policy available to cover that tax, then that means that a total of 10.6 is available to go to your heirs. So you're really maximizing how much they would receive. Otherwise, they really would have had to pay that difference straight from their inheritance. And then depending on the makeup of the assets, that could have been detrimental for, fire sales of different assets to try and come up with the liquidity. They may be getting a low value for it. So having life insurance, especially something permanent, could be really appropriate when you're planning for a taxable estate. And one of the ways we do this is by putting these types of policies in an ILIT. That's called an irrevocable life insurance trust. And the reason that's very important is that generally people say that the proceeds of life insurance are tax-free, and that's true. They are income tax-free, but if they are owned in your own name, they are not estate tax-free. So if they are in your own individual name, that would actually add to your total taxable estate, and then you would have to pay estate tax due on it, which is not ideal. That's defeats the purpose. So we work with attorneys and life insurance agents to really come up with an ILIT, the irrevocable life insurance trust, so that this is structured in a way that's going to be available to help meet the estate tax due, but not aggravate the estate tax any further than it already is.
Okay, that makes sense. So when we're trying to decide like the different types of insurance, you've mentioned a few terms, including term life and permanent life. Can you talk a little bit about the difference between those? I know there's a lot of different types of insurance, but term life versus whole life or a permanent type of insurance policy, and then where one makes sense versus the other.
Absolutely. So I'll start off describing what term life is. This is going to be your simplest policy in that it's only going to cover a certain period of time. So it's only going to pay out if you pass away within those stated term limits. And they're usually around 10, 20, or 30 years. And the reason these can be really, really ideal for most people is because they're very low cost and much more affordable. And they're generally a fraction of the cost of, for example, a whole life or a permanent policy. And this really is appropriate for somebody who's in their accumulation stage where they are working on saving assets. Because the idea is that you only have insurance for as long as you need to, and then once the term is up, you have sufficient assets to cover those needs that you were initially insuring. So what people get a little frustrated with this type of policy is that there is no cash payment. This is the purest form of insurance where you're paying for the time that you need it, with the idea being that if you outlive the term, you get no cash payment. There's nothing at the end of it. It's very similar to an auto insurance where you don't get anything if you don't crash your car. You just don't crash your car. And in this case, you live, which is a great thing. You have outlived your term policy with the idea that you have saved enough to meet those needs. But there is no cash payment at the end of it. If you determine that there is a need, if you need to extend that coverage, some of these policies are written in a way that you can convert it to a whole life towards the end of the term if you determine that, maybe the plan hasn't fully worked out. Maybe you need a few more years coverage. It doesn't make sense to do another term. You may be able to convert it. And there's often employer benefits packages that offer term life, which could be very appropriate. Because they're group policies, they tend to be even cheaper than something you could go and get on your own. As far as whole life, that is a type of permanent policy. There are a handful of permanent policies. It could be universal life, variable, index, guaranteed universal. So there's quite a plethora of permanent policies that you can use, but the one thing that they all have in common is that they're intended to be there for your entire life. They don't end at a stated term, so long as they have enough gas to get through to the end of your life. So I'll talk a little bit about that. The cash value with these policies, they all have a cash value, meaning that as you're paying the premiums, you're actually investing a cash value within them. So there's actual value to the policy. And you can often borrow against the policy, take a loan. But one of the downsides is that these tend to be much more expensive than term. They're about 10 to 20 times more expensive. And the reason for that is that this policy is expected to pay out at the end of your life, which at some point we will all pass away. So the insurance policy is banking on having to pay it. So they need higher premiums to protect themselves against that eventuality, whereas term, it's more affordable because most people tend to outlive their term. With a permanent type of policy, there are surrender charges. So if you do decide to purchase a permanent policy, you can't just cancel it the next day. There's actually going to be a surrender charge, which tends to be very high, meaning you wouldn't get anything back for the most part for about the first 7 years or so. Some of them vary, but that's what I've seen typically. So you can't make any changes, in other words, until those 7-10 years have elapsed. And even then, you may have a cash value, but the policy tends to be very expensive. You usually don't build up much cash value in the first few years. You don't really see that grow until many years have elapsed. We're talking 15, 20 years.
That's really helpful. So we have a couple of minutes, Yesenia. I'm going to open it up for questions and just remind everybody that you can ask any questions that you have using the chat feature. Let me just take a quick look here and see if we have any questions. So I think one of the questions that came in was about actually whole life or permanent life insurance. They said, I've heard some permanent life insurance is not really permanent. How do I know, or what does that mean?
Great question, and we see this all the time. Sometimes, even though you've been paying your premiums as scheduled for 10, 20 years, as you get older, the cost of insurance gets more expensive because as you get older, you're more likely to pass away. So the value or the cost of the insurance is eating into those premiums, and it may not be enough based on what they initially stated. So what happens is that it's very important to review an in-force illustration of your policy at different growth rates. Often when the policies are sold, they say, okay, if the policy is growing at a 10% rate of return every single year, you're going to be fine until age 120. Well, if we don't have 10% every single year, I think that's quite high, then that's when you want to start looking at the actual health of the policy and look at more realistic rates of return. So I usually recommend that we look at in-force illustrations for 5%, 8%, or even 0%. Sometimes we have negative years where they're going to credit no earnings to the cash value of the policy. And you want to see at what point does the death benefit stop. And there's times where we've seen that even if you keep paying the premiums as scheduled with a 5% rate of return, the policy's scheduled to go bust when you're 67 years old. And if that happens, that means that all those years that you've been paying this very expensive policy for is no longer going to be there. So unless you have a specified guaranteed life insurance product, many of these, especially variable, have the potential to go bust. So it's very important that you check on the health of those policies by looking at in-force illustrations, and I would say on an annual basis, to make sure that this policy is performing as expected and that the premiums are sufficient to keep it going for that long term.
Very good. Well, we're at the end of our time to 11:30, so we want to be respectful of your time, Yesenia, and everyone else's. Again, if you asked a question that we didn't get an opportunity to answer, we'll be sure to get back to you. Thank you, Yesenia. Appreciate your time, appreciate your wisdom, and thanks to everyone that was able to join us today. Hopefully you were able to learn a little bit more about it. Look out for emails. Go to our webpage or follow us on Facebook or LinkedIn for notices of upcoming monthly chats. Thank you, everyone. Have a wonderful day, and thank you, Yesenia.
Thank you. Have a good day.